The stock market has delivered impressive gains, especially around technology, artificial intelligence, and semiconductors. But with all those great returns, there's an underlying risk that many investors may be missing, and that is leverage. Find out on this edition of the Video Market Update. According to the Wall Street Journal, U.S. margin debt reached a record $1.4 trillion in May, up 54% from 1 year earlier. Margin debt is when an investor borrows to buy additional investments. They may borrow from their existing positions. They may borrow money from a brokerage account or something to buy additional shares without having to sell the shares they already own. Essentially, they're taking on debt to buy additional investments. Think more stocks, more mutual funds. When markets rise, it can magnify returns, but when markets fall, it magnifies losses and may force investors to sell at the worst possible time. So take a look right here on this screen, because I think this is interesting. This helps us understand a little bit more about how this leverage worked in something called leveraged ETFs, or leveraged exchange traded funds. And we're seeing a rapid increase in these leveraged ETFs. These are specific products that are designed to produce 2 or 3 times the daily movement of an index or stock. Assets in leveraged ETFs nearly doubled to a record $220 billion between late March and early June. Many are concentrated in technology and semiconductor stocks that have already experienced substantial gains. So the way that these work is, let's say the market goes up 30%. Well, if we're leveraged 2 or 3 times, that 30% rise in the market could mean we could potentially get a 90% return. And those are phenomenal returns. But the inverse is true. If the market is down 30%, I could be down 90%. And actually recently there was one semiconductor ETF that was down 31% in one single trading day. Those are phenomenal highs and terrifying and dizzying lows. And so what sometimes will happen is people will see, oh, well, everything's going up so fast and I'm missing out. Maybe I should be putting in leverage. Maybe I should be borrowing to buy more. Well, we've seen this happen before. Think Great Depression and think 2008. Those were both results of far too much borrowing. Now, borrowing's maybe in different ways, but borrowing that brought ultimate chaos. And that's not something that we want to see. So margin debt is not something we recommend. Leveraged ETFs are not something we recommend or offer to the clients that we work with. But sometimes it can be hard when you look and think, well, I'm doing what the market's doing, or I'm doing what my benchmark is doing, which might be under the market because maybe I'm more conservative. At some point, the goal is not to get rich, but the goal is to stay rich, which means I invest a little bit differently. But sometimes we all want to chase the silver bullet. And while that feels good when markets are up, it can feel terrifying when markets are down. And so for long-term investors, the answer is to understand what you own and why you own it, stay diversified, avoid unnecessary leverage, and make sure the portfolio that you have matches your retirement timeline and your ability to tolerate losses. When markets rise quickly, discipline feels boring. But when volatility returns, discipline can prevent a temporary decline from becoming a permanent financial mistake. So I thought that was interesting that it was focused on in the Wall Street Journal, and I wanted to get that to you. If you have any questions on this or anything you're seeing in the news, let me know. But if not, as always, I hope you make it a great week.